Hey guys, Marty Macisso here with Regency Realty Group. Um, haven't done a video for quite some time. Today, actually about 5 minutes ago, the Federal Reserve just raised interest rates. So I figured it's a decent time to kind of talk about that, what that might mean to people who aren't quite aware of exactly why that happens and what it means to the real estate market in general. So it's kind of it's a macroeconomic thing that every now and then governments do, and the U.S. government decided based on the strength of the current economy and to keep inflation in check, they want to kind of pump the brakes, if you will. So they increased short-term lending rates about a quarter of a point today. So it's important to know those are not mortgage rates. Those are, it's very complicated. So I'll just say it's not a mortgage rate, but it's designed to slow the economy down a little bit. They don't want it to grow too much because it creates inflation. So how does that affect mortgage rates? You probably have noticed, you might have noticed, the past few weeks, mortgage rates have gone up. They've gone up significantly. They're still historically very low. They're 4% approximately for a 30-year fixed mortgage. That's mainly that increase was due to the election, the geopolitical. It's a huge event, so whenever a major geopolitical thing happens, like an election, a presidential election, U.S. president, you're going to see the stock market react kind of bizarrely, and also the bond market. So what happened, there was a lot of carnage in the bond market, and that created, probably what's going to be a short-term increase of mortgage rates. That being said, anything can happen. They can still go up. It's hard to stay at 3% for mortgage rates. It's unprecedented. It's an all-time historic low. They're still very low, comparatively speaking. So what's that going to do to the housing market? It's probably going to slow it down a little bit. The NAR, the Realtor Association, they are projecting it's probably going to slow it down, from a very, very, very hot market, may slow it down as far as sales units go, 1%, 2%, nothing major, probably a more normal pace than what we were seeing kind of in, the fall and summer. So they do predict that home price appreciation, which means the value of your home, is still most likely going to appreciate in the coming year by about 4%, which historically is pretty solid. It's better than losing 4%. It's kind of back to normal. They want to normalize things. They don't want to create another situation that we saw in 2008, 20, 30% gains for no reason. It's why the government does these things. People ask all the time. So they did, the Federal Reserve raised interest rates, nothing major. And do I see them doing it again? Do experts, who knows? Depends on what happens economically with the presidential transition, this, that, and the other thing. But the real estate market's still very healthy. For sellers, it's still great. Probably not what first-time home buyers want to see are mortgage rates increasing. Might be a good time to get in, see a loan officer, start looking for housing that's affordable to you and your budget, and lock in before rates continue to trend upward. If they do, they might go back down. Who knows? But that's enough on that. Any questions about real estate, finance? Shoot me a message. Give me a call. Marty Macisso, Regency Realty. Thank you.